What if I told you that most investors lose not because they pick bad stocks, but because they overthink? And what if I told you there's a boring, simple investing strategy that has beaten most people, including professionals, for decades, with proof? If you've ever felt late to investing, confused by the stock market, or scared of losing money, this video could completely change how you invest forever. Stay until the end because I'll show you exactly how to use this strategy step by step, even if you're starting with $100. Let's be honest for a second. Most people think investing success looks like this: picking the perfect stock, timing the market, buying low, selling high, getting in early. But here's the truth no one likes to admit. Most investors underperform the market. Not beginners, not average people, even professionals. According to multiple long-term studies, over 80 to 90% of actively managed funds fail to beat the market over time. So the question becomes, if professionals with Ivy League degrees, advanced software, and insider research can't beat the market, why do regular people keep trying? And this is where the simple strategy comes in. What is index investing? An index fund simply tracks the entire market. For example, the S&P 500 tracks the 500 largest companies in the US. When Apple, Microsoft, Amazon, Google grow, you grow. When companies fail, they're replaced automatically. You're not betting on one company, you're betting on human progress. Over the long term, the US stock market has returned about 10% per year on average. That means $1,000 into $17,000 in 30 years. $10,000 into $174,000, $100 a month into over $200,000. And this is without stock picking, stress, or constant watching. So let's break this down and really understand what this strategy means, because most people hear it, nod their head, and still don't get it. The strategy that beats most people is index investing plus consistency. That's not two separate ideas. They only work together. Let me explain both clearly. 1. What index investing really means. Index investing means you stop trying to be smarter than the market. Instead of asking which stock will win, which company will explode next, is now the perfect time to buy, you ask a simpler question: how do I own everything? When you invest in an index fund like the S&P 500, you're buying tiny pieces of hundreds of the biggest companies at the same time. That includes Apple, Microsoft, Amazon, Google, Coca-Cola, Tesla, and hundreds more. So instead of betting on one company to succeed, you're betting on the entire economy continuing to grow over time. And historically, that has been one of the safest and most reliable bets in the world. Why this beats stock picking? Here's the problem with stock picking. To win, you have to be right twice. You have to buy the right stock and sell it at the right time. Most people get at least one of those wrong. Index investing removes that problem entirely. You're not trying to win big on one idea. You're letting innovation, population growth, productivity, and time do the heavy lifting for you. Why consistency is the secret weapon. Now here's the part most people ignore. Even index investing fails if you're inconsistent. Consistency means you invest every month, whether the market is up, whether the market is down, whether the news is good or bad. This is powerful because it flips the script. When prices drop, you're not panicking, you're buying more shares. When prices rise, you're already in the market. Most people do the opposite. They wait when prices are low, they rush in when prices are high. Consistency turns volatility into an advantage instead of a threat. Why this feels too simple and gets ignored. This strategy sounds boring. There's no adrenaline, no bragging rights, no screenshots of crazy gains, and that's exactly why it works. The market doesn't reward excitement, it rewards patience. Most people ignore this strategy because it doesn't feel smart, it doesn't feel fast, it doesn't feel impressive. But over time, it quietly beats people who are constantly chasing the next big thing. The truth most people miss. Here's the mindset shift that changes everything. You don't need to beat the market, you just need to stop beating yourself. Index investing plus consistency works because it removes emotion, it removes guessing, it removes bad timing. And that's why year after year it beats most people who try harder, trade more, and stress more. Let's talk proof. Warren Buffett, one of the greatest investors of all time, made a famous bet. He bet that a simple S&P 500 index fund would outperform hedge funds over 10 years. The hedge funds had teams of experts, complex strategies, huge fees. The index fund did nothing fancy, just tracked the market. Result? The index fund won, easily. Buffett later said, "For most investors, the best thing to do is own a low-cost index fund." If that strategy works for Warren Buffett, why wouldn't it work for you? Now, here's the part that matters most. People don't lose because the strategy doesn't work. They lose because of behavior. Most people buy when markets are high, panic sell when markets crash, stop investing during bad years, try to time bottoms and tops. The simple strategy beats most people because it removes emotion. You invest automatically, consistently, long term. No guessing, no stress. Dollar cost averaging. This strategy works best with something called dollar cost averaging. That simply means you invest a fixed amount regularly, weekly or monthly, no matter what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this smooths out volatility and lowers risk. This is how regular people quietly build wealth. Not overnight, but reliably. Realistic example. Let's make this real. Imagine two people. Person A tries to pick stocks, invests randomly, panics during crashes, and stops investing when scared. Person B invests $300 a month, buys a low-cost S&P 500 index fund, never stops, ignores noise. After 30 years, Person A might have stress, losses, or average results. Person B likely becomes a millionaire, not because they're smarter, but because they were consistent. How to do this step by step. Here's exactly how beginners can start. 1. Open a brokerage account. Examples are Vanguard, Fidelity, Schwab, or any trusted platform in your country. 2. Choose a low-cost index fund. Look for S&P 500 index fund, total market index fund, expense ratio under 0.1%. 3. Set automatic investing, monthly, no thinking. 4. Hold for the long term. Years, decades. That's pretty much it. Mindset shift. The biggest lie in investing is that it has to be complicated. The truth is, simple beats complex. The market rewards patience, discipline, and consistency, not intelligence. If you remember one thing from this video, remember this. You don't need to beat the market, you just need to stop beating yourself. If this video helped you, like the video, subscribe for simple investing and money strategies, because the best time to invest was 10 years ago. The second best time is today. Since today is here, let's get started.